Hi, guys. I'm Lawrence from XD Academy. Today, I'll be speaking with Stephan Lutz, CEO of the legendary crypto derivatives exchange BitMEX, inventors of the perpetual swap, and my old company. I'm especially excited to talk to Stephan today because I know most of the people that I have the pleasure of interviewing, but Stephan and I actually worked quite closely together at BitMEX, and I'm excited to hear from him how things have been going since I left, as well as his perspective on some of the issues that we're seeing currently involving regulation in particular, and how he thinks about a centralized business operating in a decentralized world. Stephan, thanks so much for joining us today.
Thanks for having me, Lawrence. A great pleasure.
So, Stephan, for those listeners or viewers who may not know you, would you take a moment to just introduce yourself?
Of course. I'm Stephan, CEO and Group CFO at BitMEX, as you introduced me. I joined the company 2021 as CFO and was appointed then in late 2022 to provide strategic counsel for BitMEX through the industry-shaking events, including the FTX meltdown. Prior to joining BitMEX, basically, I was a banker all my life. But I worked in different capacities. So I worked at a bank. I worked, for example, as CFO of a shipping company. I worked in the exchange space. So I was a long time with Deutsche Börse, one of the largest stock exchange operators globally. And before joining BitMEX, I served 9 years as a capital markets lead at PwC. But I'm not an auditor. I always were an advisor. So what is of interest is basically that I've been with the distributed ledger technology and crypto personally since 2012. Sometimes more, sometimes less, but always were there. So when I was asked by BitMEX and the founders in 2021 to join, that was a great moment for me to combine personal interest and activity with actually professional work.
Very exciting. And of course, we worked together while you were there. I've been gone for a little while now. Maybe catch me up on what's been going on at BitMEX.
I'd say, back to the maybe old days a little bit. For those who have seen BitMEX and followed BitMEX ever since, BitMEX started as an all-over crypto derivatives peer-to-peer exchange that was geared to serve professional traders. So professional doesn't mean just corporates, but people who want to make a living out of crypto trading, who wanted to buy, sell, hedge their crypto exposure via derivatives. So if you look back a little bit, I'd say since 2020, there was a strategic pivot to go more broader, a little bit like what everyone did during that time. A lot of retail adoption was targeted. We wanted to grow a couple of business lines which were outside of the derivative space. And I'd say what happened since you left us is basically that we have boiled that down and we're back to our original niche, serving more or less, I'd say, Bitcoiners and crypto natives and professional traders who really are in for the trading experience of crypto derivatives, right? So we're very focused right now, again, making sure that we can live up to our promise, and we try to get back on the path of continuous improvement and rolling out new products and functionalities.
Yeah, I love that. That's such a great explanation. And maybe for those listeners who may not be, very deep in their background of finance, can we talk just a minute about what a derivatives means in the crypto space and what, the kind of derivatives that BitMEX offers?
Okay, now you got me. Okay, let's see how we can do this. So, well, first of all, if you're in the industry and in the crypto exchange industry, people usually talk about spot and derivatives. What does spot mean? Spot means outright buying and selling or holding crypto coins. Like you buy a Bitcoin and then you hold it, then you sell it later on. That's spot trading. And a lot of players do that on large scale. What the holy grail in that one is the so-called fiat to crypto conversion. That means how can you exchange your fiat currency into crypto? We have a spot market, but we don't focus on fiat on-ramping or off-ramping. Our main capacity is crypto derivatives. Derivatives means you can have exposure in crypto. So in maybe not any coin, but in most liquid coins that are out. And you can have the same exposure without actually needing to hold a lot of either fiat or crypto yourself. So that means you enter into a so-called futures or perpetual swap contract, which gives you the same capacity. So usually it's used by people who have crypto already and want to hedge it. So if you're in financial markets, you can have a future, for example, on the Fed funds rate, and that gives you protection about rising or falling interest rates. For crypto, it's the same. If you trade Bitcoin future, it gives you protection against falling or rising Bitcoin prices on the spot market. So, and here comes the future and the perps. The futures basically have an expiry date. They have a maturity. Usually you go for 3-month rollover dates. And perpetual swaps are basically indefinite contracts. So you can let them run for as long as you want, as long as you're happy with the price discovery and happy with the price development of the underlying crypto, let's say Bitcoin in that extent. And it gives you an ability to trade those exposures faster because there is more liquidity in the derivatives markets than in the spot markets. And this is a general notion. So if you want to, for example, bid on Bitcoin like 30,000, you're much more likely to get something in the derivatives markets than buying one Bitcoin and then waiting until it rises until 30,000. And the second one is if you want to buy one Bitcoin, you need to basically have whatever the price is right now, around 25 to 26K US dollars to buy that. If you go the same for crypto derivatives, you basically need to deposit as an initial margin. That's the word for it, like a fraction of that. So you can participate in the ups and downs with much lower outright exposure. At the same time, you have a little bit more risk. The more volatility you have, the further your positions will go in and out of the money. That's called. So you make money or you lose money faster than withholding it outright. That's basically it. I mean, and then there is a lot of technology around that to make sure that there are no, or let's say reduced credit risks, that you can be sure that your funds are safe. It's then an insurance fund that gives you a little bit or basically a significant protection against other traders going rogue on you and that stuff. So there is a lot of technology around that, which was invented by the founders of BitMEX basically, and then copied all over the space. We're still here, and that's it.
Yeah.
Hope that's okay.
Yeah, that's perfect. And I'll just add, because I do think that a lot of our audience, or at least the audience that we hope to cultivate, are the folks that aren't necessarily just pros, but maybe interested in learning more about the space and developing into this space. And it feels like a good point to make. One, that it's hard to overstate what a game changer it was when BitMEX introduced the perpetual swap. I mean, to this day, when you see, there was an announcement recently that Gemini is going to start offering derivatives, and the Winklevoss twins are going around talking about the importance of perpetual swaps and why these are the instruments that the community really needs, the market really needs. This is 100% a BitMEX product that was invented by BitMEX and the founders. And the second part is the importance of derivatives in general. I think a lot of times people don't necessarily understand derivatives. And we came out of 2008 with a very negative view on derivatives that I think, although it's, 2008 is a good deal in the past now, sometimes there's a little bit of this feeling of that, like derivatives are these like super risky instruments that have the ability to bring the whole system down. But actually they have a very important place in the financial system. And there's a good reason why the volume traded on derivatives is so high, throughout various different asset classes. So I would encourage anyone interested in this to look into those two things specifically.
Maybe if you allow me, Lawrence, this is really hitting the nail on the head, right? And this is why me coming from, let's say, even classical financial services, it's a major point. Crypto derivatives, just for the benefit of everyone, just to repeat it, work completely different than in the classical space. In the classical space, if you, for example, go to whatever Eurex, to CME, CBOE, what have you, to the big exchanges, and you trade a futures contract, what you usually have is you place your initial margin and then your position develops. So that means over time you will receive margin calls and they will accumulate. So if the position is going against you, so you lose money, actually, you can lose more than you originally, let's call it, deposited or placed with this exchange. And this is what brought the whole system into problems in 2008, because banks were trading with each other on a, let's say, uncollateralized basis, and then all the margin calls led them to fail. In crypto derivatives, it's a little bit different. You have a different risk. So the risk is not that you can lose more than you deposit. So with any crypto derivatives exchange that's legit out there, you basically will be, and this is a famous term, you will be liquidated if your funds are not sufficient. But then that's it. So no further clawback, no recourse. So if you, for example, trade for $10,000 and you lose $10,000, it's the maximum you can lose. No one will call you up. No one will send someone or liquidator to your house and and get stuff out, right? So crypto derivatives in a way are much less risky, for the system as well as for every user, than in the classical financial services space. At the same time, you need to monitor your positions much more closely than in the financial space. In the financial space, you just let it go and you hope your bank to take care of that and call you up at the right time. In crypto, you need to take care of that yourself. But this is why crypto was invented in the first place, to take charge, right? To be responsible yourself. So that means if everyone is responsible, the systemic risk is lower. Sorry, I just needed to make that point because that's often misunderstood.
Yeah, I don't mind digging in a little deeper on this thread, actually, because I agree with you that this is often misunderstood. So I guess maybe to make it even more clear. Now, I understand this. You know that I understand this, but we'll talk this through, okay, for the benefit of folks that may not. So if I'm using leverage in a traditional market, right? So let's assume that people have some very basic understanding of what leverage is. I want to make an investment that mirrors the return of an investment higher than the amount of capital that I allocate to the investment, right? Mm-hmm. So let's use a simple example. Let's say I want to buy an Amazon stock. I'm super confident. I've done my homework. I'm super confident Amazon is going up. And I want the opportunity to get enhanced returns for the amount of capital that I can dedicate to that. So my first option is I just use my $100. Let's say an Amazon stock is $100 today. I buy $100 of Amazon stock, one stock on the spot market. It goes up. That's my return. But in a derivatives contract, I have the opportunity to say, hey, with my $100, I actually want to buy the returns of 2 Amazon stock, right? Now, the problem is that ratio goes in both directions. So if I was wrong and my position goes down, I can have a negative return in my account, let's say, right? And in the old financial system, if I have a negative return, I could be in a position where I owe money to the whoever facilitated my trade. Is that correct?
Correct.
Okay. Now, in crypto, we don't do it that way, right? How do we do it in crypto?
It's different. So as you say, so in classical markets, you go into derivatives contract for an Amazon stock, and let's say you have 2 times leverage. That means you in non-technical terms, so all the fans out there will say, oh my God. But in general, it basically means you make twice as much money from the underlying position, or you do it twice as fast, depending on how you want to calculate it. And it goes both ways, as you say. The issue in classical markets is if you lose, usually it's not seen immediately because it's not a real-time system in a way. So what you owe to someone might accrue quite for a bit of an amount, right? Let's say you went in with $50, but you owe somebody at the end of the day like 1,000. That might happen in market turmoils. And if that goes on over a couple of days, it amounts to a lot of money. In crypto, basically, there are 2 things to that. One is you can't lose more than you have. So that means if the $50 you have put in are gone, then it's gone. Then you will be, this is this famous term, liquidated. So your position is gone because your money is given to the one who won on that trade. It's always a bilateral one. So you lose, someone else wins, or you win and someone else loses. So to make sure that the winning party is actually protected. At the same time, and this is a second big innovation in the crypto derivatives market compared to classical markets, there is kind of a market practice that positions are basically settled every 8 hours. So you can't accumulate more loss than in an 8-hour cycle. I mean, still you need to look at your position, but frankly, there is not much more risk, especially for the winning party. It's good because every 8 hours, if you're, let's say, settled in an intermediate way, the position is still good and your counterparty is still good too. So you don't need to take care of a lot of credit risk. And this is important because it's a peer-to-peer market. It's not like in classical financial services where you have a lot of intermediaries that are just there to make sure that you're eligible to trade, right? In crypto markets, basically, technically, everyone can trade, and this needs that protection. We go at BitMEX even over and on top of that. We call it basically an instant P&L realization. We have gone to basically now settlements every 10 minutes. So that reduces the risk even further for the legitimate traders on our platform.
Mm-hmm. Yeah. And in a way, doing it this way is very true to crypto, isn't it? It's like a permissionless way, trustless way of facilitating trading, because you don't need to know my ability to pay back a negative balance, right? Exactly. You're giving me the same opportunity, the same power, without having the ability to accumulate debt against you.
Exactly. It's to look back at great financial crisis. There were two things that were happening. One is accumulating losses that no one really knew or have seen. So that was basically a Lehman moment. They received margin calls and they couldn't meet them. I mean, long term, it's a different story, but short term, they couldn't meet them and they didn't see them coming. So that was basically their problem. And this is one problem. So you can say, okay, I'm at a loss and I'm not able to cover up for that loss. But this is not the systemic risk. The systemic risk is that others have relied basically on your position to be honored, right? Mm-hmm. So for example, if you see Lehman, just to make it explicit, let's say they have owed the market, which is impersonal right now, like just making up numbers, it's not the real number, but let's say $10 billion US. But there have been people, and not many, it's not like thousands of them, but a couple of them that thought they were 10 billion richer and they spend it somewhere else. But in the end, they didn't get back their money. So they were indebted then on the next level. And this is this domino effect that happened in great financial crisis, right? Everyone believed that they had valid positions just to be disappointed in the end at not getting their money. And this is, as you say, very true to crypto, why it was originally invented and how then the derivatives world was, let's say, reinvented on that one as well. Your risk is basically maximum 8 hours, with us even lower right now. And you can do it without needing that trust and just say, yeah, it will be all good. No, you know whether it's good or it's not, and you will be informed in due course.
Yeah, I love it. So, I mean, BitMEX clearly has a crypto soul in a sense, right? I mean, and BitMEX came out in the early days of crypto. We went through a phase, certainly in the last bull market, I think, where people started really seeing crypto as a business opportunity, more so than a financial ideology, which is I think fine. But if you look at the way BitMEX works and the products that they invented, it's clear that there's a lot about sort of the ethos behind why crypto was created in the first place that went into the platform and is still there today. Now, that said, BitMEX is not a DeFi platform. It is a centralized platform. And I'm interested to hear how you think about being a centralized service in a world that really values decentralization.
Yeah, absolutely. And this is not just in the communications way. That's a good question. And that's basically going to the heart of BitMEX. We believe, frankly, that centralization and decentralization needs to go hand in hand. And the invention of crypto or the proliferation of crypto surely pushes the boundaries of what can be done in a decentral way, right? I mean, I just recommend looking at transaction cost theory for the interested listeners to that podcast. Then you understand what it's about, frankly, technically speaking. At the same time, it doesn't mean that everything will be decentralized by 100%. And why is that? Look, if you use a service, for example, that you understand by heart, where you know everything about it, you know about the processes, how it's usually or should be done, where you know the product and where you know even the technology. And if you're able to, let's say, read/audit on a technical level the underlying smart contracts, frankly, if you are that, then DeFi, I guess, is your choice. Because it would be mine. If I know everything about it and I'm basically an expert in that space and I'm using it regularly, so I know exactly how to use it and I do it multiple times, then it's a decentralized way I want to settle, right? But if you say, hey, my actual business is something else, I want a problem to be solved by someone else. And I want that this someone actually is approachable, that I know where they sit. I can call them up. If something goes wrong, there is a technical incident. You might not be wanting to be on a pager duty and then dive into that problem yourself. You want somebody else to take care of that. Or you use a service or a certain functionality just once in a while. Then you go for a centralized service provider, because then if you lose your keys, it's gone. If you have a technical incident, it's gone, right? So in a way, on an exchange basis, I think there is enough market for both. We would love to see more decentralized players and big decentralized players who are there for good, right? Because that is actually, as you say, it's within the ethos of crypto. At the same time, we recognize, and this is how BitMEX was set up, that not everybody can, let's say, dive into the mechanics of margining systems, of how you initiate withdrawals and deposits, how you do sweeping mechanisms and all of that stuff. That some people are actually trading professionally, but they are trading, let's say, every second day or so, or maybe once a week, or they go on macro, which is even lower, but they still want to use derivatives, but they want to call up somebody if their 2FA isn't working, for example. If there's another problem, that at least they have the ability to speak with someone. And if you look at BitMEX, the funny thing about BitMEX, I mean, it's not funny, but actually it's remarkable. Since the time when the founders were around, you always knew who was in charge. Right? There was no ambiguity about that. I mean, founders have been very vocal, especially Arthur. I mean, everyone knows Arthur in the public domain, right? So it wasn't that there were some dubious people who no one knew and where you didn't know where they are. And this shows how confident we are for our business model, I think. And that still is the case today. So you can actually approach BitMEX people. Yeah, I mean, I'm in the podcast with you. You know, actually, even where I live, and that is true for all of these of the management or even the team within BitMEX, and we are proud of that.
Okay, I guess maybe reading through the between the lines of what you just said a little bit, though, I want to ask you a very direct question. Would you say that you're not, speaking as the head of a centralized, trading platform, do you or do you not feel threatened by a DeFi platform that could match some of the performance or features of what people could get from BitMEX today?
Short answer is no.
Yeah.
But there is a color to that. I don't feel threatened. Why? If really there are platforms out there that provide exactly the same service without differentiation in a decentralized manner. Frankly, that's what the industry and what crypto is about. So I'm happy to see that. Why I don't feel threatened actually is for a different reason. If you look at this, is it centralized or decentralized right now? Then it's a so-called red ocean market. It would mean crypto has reached its full potential and it's just a competition between players, and you just distribute the market shares. I believe, frankly, that with a combination of decentralized players and centralized platforms, there's more than enough opportunity to even increase the adoption of crypto overall and provide that. I don't like the word, but it's just my English. I guess if I would be native, I would find other words, but let's say trust, or let's say confidence in the market, that it's there to stay and not something that goes up and down. I mean, if you look at BitMEX, we are not where we have been like in the early days, but we're still here. And that's almost approaching a decade right now, which in banking would be like we would need to exist since mid
1600s. Yeah. Exactly. Yeah. Your name would have to be Medici or something, right?
Exactly.
Yeah. No, thank you for that answer, because I think that's something that people think about, and it's good to get a direct answer and a truthful answer on that one. Speaking about longevity, I think it seems like, in crypto, whether or not you've had a run-in with regulators seems to be a factor of how long you've been around and how successful you've been to some degree, right?
Yes.
Because we operate in a world where the regulation is extremely unclear. And, a lot of times the only time that you hear about what the rule might be is when the enforcement action is being taken. And we see two of the biggest names in the space dealing with that now, Binance and Coinbase. Tell me a little bit about what your thoughts are on these, actions in particular, and maybe, what how do you see this affecting the market in general?
Yeah, short answer to your last question, yes. it will affect the market in one way or the other. I mean, recent, especially Binance and Coinbase news, I mean, they shaken up the industry, right? And we are monitoring the situation very closely, especially with our past and history with regulators as well. I mean, in one way, it's clear that the regulatory scrutiny has been intensifying around the industry, especially in the US. And I guess that all the crypto native players will face quite significant challenges, at least in the next month to come, right? This is just observing. One remark: we are not operating in the US market, so which is part of our learning over the past years already. Still, I think the current situation shows you that there is a mismatch of old and existing laws in regulation, but they try to put them onto new industry. I mean, I can't predict the outcome of this episode of the crypto crackdown, but I think it's an opportunity, frankly, for the industry and other regulators around the world to readjust their strategies right now. Why do I say this? And why do I mean readjust the strategy? I guess for the crypto world, it's about where do I want to be in that landscape? And do I agree generally with the notion of regulation or don't I? And for regulators, you see where it goes if you don't do it correctly. I think that at that point in time, and that's very direct and I mean, maybe not controversial, but not everyone likes to hear it. I think the US are in a state where they don't know what to do with it. And this is what you see. If you look at Hong Kong, I mean, Hong Kong was crypto friendly, then they turned against crypto. Now they're crypto friendly again. And why is that? Because they went through this time of uncertainty. They now have made up their minds and they know where they want to go because they understand the technology. I mean, at least better than others. You see the UAE, they have made up their mind. Even if you go to the European Union with MiCA, the markets and crypto assets regulation, you might not like it as a crypto player because it's overly cumbersome and it's basically kind of banking regulation for crypto. So it's just, but it's basically copy pasting. So from my point of view, it's not very fit for purpose, but at least it gives you clarity where you can go if you want to operate in the European Union, right? In the US right now, at that point in time, with the information I have, I know nothing, right? I mean, it's a complete pivot. I mean, even the interpretation of some of the securities laws on crypto, I think, and I'm from that space, so I have an opinion here, is a bit weird sometimes. Let's say I have understanding for where they come from, and that they have an issue now with, for example, the FTX incidents that happened and others as well. And they are scrutinizing AML KYC, which is their right. It's all okay. But they taken a route that is doing the opposite of what regulation should do. Regulation, if done correctly, should give you certainty. You might not agree to the regulation, but it should give you certainty. It should give you protection of your investments, right? And I don't mean just for depositing funds. I mean, even as a company or as a DeFi platform, if you have regulation in place, it gives you at least the certainty that the next couple of years you can operate in a pretty stable environment. And what we see in the US is that this is completely gone, at least for the time. No one knows what's going to be there next year or the year thereafter.
Yeah. And I think we're at a point where it's quite difficult to even defend. I haven't heard anyone convincingly be able to defend the US regulators and what they're doing, right? It's very punk rock and, pro crypto to be like, US regulators don't know anything. But I mean, it's hard to make a counter argument to that, because it's just so confusing what's happening there, and there's so much apparent inner turmoil even among the various regulators about who does what. Okay, fair enough. Let me ask you this: where are we in the current crypto market cycle? As someone who watches the markets very closely, I'm sure you have some opinion of this. Obviously the thing that is on everyone's mind is, are we still in crypto winter? Has the spring started to come, or did we have like one of these false springs earlier this year? What do you have any thoughts to share on that?
Sure. Well, and this is, I mean, the usual caveat, this is no investment advice. Right.
Of course.
Sorry, just a personal opinion. So for me personally, what I see and observe is that the major currencies like Bitcoin and Ether, which we care about a lot, remain quite resilient at the current market levels. And this amid regulatory challenges and liquidity issues, which is a positive sign. And if you look at even on-chain data from, for example, Glassnode, it shows that trades gradually transferring assets from hodlers, so from holders. So everyone in crypto knows hodlers, but from hodlers to new market participants. At least this is how it looks like if you look at the on-chain data, which is a healthy indicator signaling market transition to a bull market later, right? It doesn't mean it's there yet. So, and for investors, the visible short-term effects on the SEC cases against Binance and Coinbase are basically a downside pressure on prices for crypto stocks and altcoins, not so much for the base crypto coins, right? So I believe that crypto investors at the moment are likely to divest those and go into Bitcoin and maybe ETH, right? Because at least Bitcoin is unlikely to be deemed as a security. Ethereum, let's see what SEC is going to do here. And what you see as well is that according to the data from TradingView, Bitcoin's dominance in the total crypto market capitalization rose again and is basically, I think, as high as in April 2021. And even the Tether dominance has jumped and is the highest since January 8th. So I'd say winter isn't over. We see a lot of positive signals like quantitative easing. Well, not outright, but if you read the Crypto Traders Digest from Arthur, you know our view. But it's coming. So it's a little bit of patience that's still necessary. I'd say if you compare it to seasons, we might be like beginning of this or shortly before Christmas. I mean, not for the Christmas present, but in terms of season. So, spring will come in due course, but it's not there yet.
Yeah, got it. Okay, so spring will start showing up around Christmas time this year. That'll be good, like Southern Hemisphere style. Okay, Stephan, thanks so much for your time today. I'm really excited to talk to you. As you know, the way we structure these conversations is I think up of a theme that I think is current and will be interesting for people to learn about. I set it up conversations with 3 people that I think will have something interesting to say about that theme. I have individual conversations with each of you, and then we get together to have a group discussion, which for us will be taking place next week. I'm really excited to have this group discussion in particular. I think it's going to be really great, and I look forward to seeing you next week. Thank you so much for your time.
Same here. See you soon.
Hey guys, I hope you enjoyed that conversation as much as I did. If you're interested in learning more about any of the subjects we spoke about today, or just want to meet some cool, helpful people in the space, please consider joining us at the XD Academy Discord server at dsc.gg/XD Academy. We'll be offering special rewards for the first 100 and 1,000 joiners of our Discords. I think we might be already over 100, so try to get into that first 1,000 group. And so make sure and get in early and be whitelisted for special perks. I'll see you there.